Hi, I'm Merryn Somerset Webb, Editor-in-Chief of MoneyWeek magazine. Welcome to another one of our video interviews. With me today I have Mark Slater, who is the founder, chairman and CIO of Slater Investments. Many of you over the years may have read articles in the magazine about and by his father Jim Slater, so we already have an introduction to your style of investing, Mark, there. So tell me, your core strategy and your most important fund is growth.
Yes.
Can you explain to us, before we go on to anything else, what you mean by growth? Because we get a lot of different definitions.
Yes. Well, I mean, labels are very interesting in the investment world because I think people tend to feel that, with particularly growth, that growth is sort of momentum and expensive over here, and value is sort of cheap but hopeless over here. What we're trying to do is to buy businesses which have a degree of dynamism in terms of earnings growth, but we're trying to buy them, introduce sort of value factors as well. So we're trying to buy them cheaply. So if you like, it's growth. What we're looking for is growth at a reasonable price.
Okay. Isn't that what everyone's looking for?
Not everybody, because some people are after yield, some people are after deep value.
But even if people say they're after yield, they're after a growing yield, so they're still effectively trying to buy growth at what they consider to be a reasonable price.
Yes, I mean, I think what we try and do, though, is introduce a significant value of safety, margin of safety, by using these value factors. So, there are growth companies we wouldn't buy. So, for instance, we don't own ASOS, the online retail business. It's been a mistake, by the way, not to own it, but we don't own it because it's on a multiple that's 50, whatever it is. It's a very, very high rating. We don't go beyond a 20 multiple of earnings. That's one of
Okay, well, let's talk about those parameters. What are the parameters that tells you something is a reasonable price?
Well, we screen the entire universe.
When you say the entire universe,
of the UK market.
Of the UK
so
market.
We screen that entirely.
All sizes.
Everything. Yeah. To begin with. And we are looking for businesses which are likely to grow their earnings, over the next few years. Mm-hmm. We look for a degree of consistency in the past. We look for companies where we can buy that growth relatively cheaply, which is the sort of value factor. And we use the PEG as the sort of at the wide end of the funnel, comparing the PE with the growth rate. We look for cash flow in two ways. We're looking for businesses which convert profit into cash, and also which generate free cash flow. And those key areas, in other words, growth, reasonably priced growth, and cash flow, get rid of 90-95% of the universe straight away. I mean, most companies are not growing, or they're expensively rated, or they're not generating cash. So very quickly, we have a manageable short list of companies which are worth focusing on. And in our view, we've got rid of an awful lot of rubbish. So we then, with our short list, we focus then on businesses really from that point on, where we started in a much more qualitative way, and once we have our shortlist, we start in a quantitative way, and then we become much more qualitative.
Okay.
And the qualitative factors we're looking for are sort of high returns on capital, which is normally indicative of a good quality business. We want ideally businesses in some sort of niche, some sort of business doing something particularly well. And I think the most important thing we're trying to identify is a tailwind that gives us confidence that growth will continue. And that can come in all kinds of shapes and sizes.
Okay, does this involve meeting the management and engaging with the management before you buy?
At the end.
At the end. Yeah. So the last part of the process is to go and see the management.
Yeah, I think it's the least important part. For us, it's the least important part, mainly because I think it's easier to assess a business than it is to assess a management team. Management teams, if they're any good, are trying to sell the business to you. So
yes.
They have a conflict.
So if you see them early on in the process, it may sway your judgment during the remainder of the process.
Yes, I mean, the normal thing is, and I've had this in the past, where, when we started out, our biggest mistakes tended to be related to meeting management too early. So you would hear, management would tell you that they're very confident they might win a big contract or whatever it might be. And if you hear that too early in the process, it's difficult for it not to sort of disturb your thinking. If you meet them at the end of the process, you know the question, you know which gaps you want to be filled in. You know what you don't know, or at least you think you do. I think it's a much healthier way of going about things. Okay,
so let's say you get to the very end of the process, you go to see a management team. What is it that might then stop you buying? What is it about a management that is off-putting?
Well, I think there aren't that many things, really. I think, obviously, if they have a bad track record, that weighs on things. If they're If they come across as dishonest, then that's a deal breaker. Or if they have a track record of dishonesty, even worse. But we probably wouldn't be meeting them with that.
Well, I was going to say, hopefully you wouldn't have got to the last bit.
We would probably have identified that earlier. But those sort of things. Really what we're looking for when we meet management is to understand the business a bit better and to try and understand their long-range view. And if it's intelligent, and if their hopes for the business are intelligent, then that's likely to be supportive of the investment case. Occasionally you do get situations where they might tell you about things about the business that you don't like, or they might tell you things about their own plans for the business you don't like. So it's more strategic and how they see the business and what they're hoping to do with the business. It's that kind of stuff that we typically.
And once you've bought, do you keep engaging with management? Do you see them regularly, or are you a...
No, we see them every time they report, basically. Not every time they announce something. That's would
be
about
quite
every
boring.
2 weeks.
Yeah.
But in most companies, it's endless now. But probably twice a year, maybe 3 times a year. If the business is a little bit complicated, it may be a bit more than that. But it's we're not all over them, and we engage to the point where we're just trying to understand what's going on. We don't go much beyond that unless it's a problem.
Okay, and how many? Let's stick with the growth fund because it's the most important one for you, really, isn't it? How many stocks in that portfolio?
Today there are 50. We typically have between 35 and 50 names. At the moment, we're actually coming down. The number will end up somewhere between 42 and 45 once we're clearing up a little bit of a tail of smaller positions.
Okay, and what's the rationale behind that number?
No, the main thing, we believe that you can't have an infinite number of good ideas. We typically have 35 to 45% in the top 10 names. So there's a reasonable degree of concentration in the best ideas. The tail of stocks tends to be either slightly lower conviction positions or less liquid positions.
Okay.
But really, it's just that there aren't enough good companies to have a lot more than 50 names in our.
You've done the entire universe of UK stocks and end up with 50.
It's pretty sad, isn't it?
It's really sad. It's not encouraging at all.
No, but some are better than others, so it's important to own the ones that are best.
Okay, well let's talk about what is in the fund.
Sure.
What's particularly interesting at the moment in terms of sectors? Perhaps let's start there.
Yeah, I mean we don't tend to we do end up sometimes with concentrations in.
Yes, I mean
sectors.
you may not look at sectors on purpose, but you will find you'll end up
you can
with.
End up there. So and I would say, but there's no particular sector theme, because the sectors where we do have concentration typically are kind of catch-all sectors. Support services means anything you want it to mean.
Anything.
So, we have our bigger positions are typically quite niche businesses. So they're, one of them reported today. It's a company called CVS Group, which is the leading veterinary business in the UK. It's a fantastic business because it's an area where it is discretionary spend to a degree, but people tend to look after their pets pretty well now.
And anyone who has a pet will know just how the margins for veterinary businesses must be.
They are fantastic, and it's also an industry which is still very fragmented. And this company is the leading consolidator. It's just a great model. It generates lots of cash. There's good visibility for us as investors in terms of future growth. They've got a long way to go in terms of the consolidation. I mean, today they had a 10% upgrade to earnings this morning based on good trading to date this year.
And is the pet population in the UK rising or falling?
It depends on the pet, but it's risen a lot over the last 20 years. I mean, the direction of travel is positive, but this company is also unusual in they can handle big pets as well as small pets. So which is
what's a big pet?
A horse. They're very expensive. So and they're also taking the model into Holland, which is a very comparable market to the UK. They've just started doing that this year. So there's a lot. I think they'll do pretty well there. But the key thing is the nature of spend. The only way in which the like-for-like growth would drop is if unemployment picks up significantly. But otherwise, the main issue is the weather. Because if it's raining, people don't take the dog for a walk, and the dog doesn't get injured. It's as simple as that. So it's.
But the dog gets fat.
Yeah, but
that may need attention too.
Well, I guess ultimately maybe, but what I like is, there are a lot of problems in the world. There's generally a lack of demand in lots of areas, and this is an area where people spend money, and it's a priority spend. So, it's for us. It's there's a clear tailwind behind this business, and I think generally, and this has been the case, I think since the crisis, for most businesses there's a degree of headwind. So it's a much better place to be.
Okay, and that comes at a reasonable price.
We bought it at a very reasonable price. It's had a good run, and it's trading today on around 21 times next year's earnings.
Okay, so it's not that far off your limit.
Yeah.
Because you said you wouldn't go beyond, was it 25 or 20?
20.
Did you say 20?
20 forward.
Yeah.
But we wouldn't, but our point of entry, we won't go above 20, but we will run profits beyond that.
Okay, so where are the parameters for selling then?
Quite different, really. I mean, I think I think there's quite a significant difference. We won't go above 20 times when we buy. We will run profits quite aggressively, and really there's no particular multiple number. It very much depends on the quality of the business and the growth rate. What we tend to find with the best businesses is that they outperform on the upside in terms of expectations. You get lots of upgrades normally. They're also very hard to replace. So and again, over the years, we found this in the past where if we're too quick to take profits, you very often end up buying the same company back a year later, which is silly. So we typically buy businesses as long as the business is doing well and the dynamics are in place. As long as the price doesn't go mad, we will hold for a very long time.
Okay, so what's the turnover in the fund?
Very, very low. I mean, our average holding period is about 5 years.
Okay.
And when we buy businesses, ideally we will own them forever. That's obviously an ideal. It's rare we can actually do that because normally either the price goes crazy or the growth rate might quieten down at a certain point. So we have to manage that. But our aspiration with a business is as long as it keeps doing its thing, we will keep owning it for a very long time.
And this is quite important because it keeps your ongoing charges relatively low, despite the fact that your management fee is relatively high.
Well, our management fee is not that high. It's normal.
1.5%.
Yeah, but the platform charge is much lower. Yeah. Okay. So most people nowadays come through a platform.
Okay.
Our dealing costs are low. Yes.
Yeah.
And we're very mindful of that.
Right. Well, let's get back to the stocks. What else is interesting in the portfolio?
Well, I mean that is a great business. I mentioned CVS just because
it
reported this morning.
Yeah.
So. But we own a lot of niche businesses of that kind. So another one we own is, which has it's comparable to a degree because it's an acquisitive model, is a company called Restore Group, which we've owned now for many years, about seven years, I think. And they are the leading, the second largest player in document storage. Very boring, simple business. It's an annuity stream. Once Linklater sends their boxes off to be stored, they're going to be there for over 20 years. Scanning is extremely expensive, and as a result, people keep producing paper. The average professional firm's store of boxes will rise between 5 and 8% per annum. So the paperless office is a complete myth.
Total myth.
We all know that. Apart from Google.
Yeah, but we all know that from our own offices, right?
Exactly.
We're all surrounded by piles of paper.
You send an email, you print it off and read it. If it's a long one.
I don't know if I go quite that far, but maybe.
But a lot of people do. If it's very long, or if it's and certainly in professional firms, accountancy, law, they do need reams of paper to do what they do. And so you've got an annuity stream in terms of the customer, all the boxes the customers send them to store. They've also gone into, and that's been a wonderful model over the years because you've got the organic growth behind this, just the number of boxes being stored. You've also got highly accretive bolt-on acquisitions, and we're not great fans of highly acquisitive businesses, but when companies can do bolt-ons in their area, it's much lower risk. It's a very, very attractive thing to do, I think. And they've been able to buy lots of mom and pop operators all over the UK and consolidate them on a highly accretive basis. They've also gone into other areas of the office environment. So they've gone into shredding, they've gone into scanning, they've gone into a whole lot of other areas that are related. They've gone into office moves as well, actually. And the dynamics in those industries are also attractive. So and the spending decision is often made by the same person who makes the decision on the boxes. So there's lots of good common sense behind what they're doing. And again, they've achieved an earnings growth rate of between 15 and 20% per annum for a very long time. and they're still delivering the goods.
And are on a price that would still be reasonable to buy now, or
Yes,
you've held them a long time?
It's reasonable. We held them a long time, but the multiple is in the sort of upper teens.
Okay.
So nothing. But with that kind of growth rate, I mean, I certainly would say that a 15% growth rate today is comparable probably to a 30% growth rate not that many years ago.
Yeah.
It's tough to grow at that rate. So and when a business can do it on a low risk basis, it's very attractive.
Now, neither of these businesses, and I'm assuming most of the rest in the fund as well, sound like the kind of businesses that will be hugely affected by politics.
No.
So there's been an awful lot going on in the political environment recently. We've had Brexit, we've had Trump, we've had all the worries in the EU, etc. Do any of these things make any difference whatsoever to the way you invest?
No. The short answer is no. I think
that's the answer I was expecting, by the way, but I'd be interested if there was a long answer.
No, there is a long answer. I mean, I think the American election we weren't particularly bothered about. I mean, as citizens, it's interesting, but as investors, I don't really think it has a huge impact on the kind of businesses we own. They're just doing their thing.
Yeah, and it might give a little bit of global growth, which could make some difference
around
the margins.
So, yes, no, I mean, personally, I think Trump. Well, I mean, from where he started, I think he can't do anything but surprise on the upside. From where we are now, people are now assuming there could be a good boost to growth. We'll see. I think that there's a range of expectations there, and I think the upper end probably will be disappointed. The lower end probably will be pleasantly surprised. But my personal view is, it isn't a bad idea to try something new. QE in the end isn't going to work. It hasn't worked. So I think it demonstrated that Big Brother was the government and central banks were there to help, but no more than that really. So I think that high levels of spending is an experiment that needs to be tried. So I'm not worried about Trump, and it didn't have any meaningful impact on the companies we own. Brexit, interestingly, at the operational level, has had a minimal impact. I mean, pretty well even companies which are very consumer orientated in the UK, house builders, Marston's, the pub business, they reported this morning. Even businesses like that, they're all coming out and saying there is no discernible impact on their day-to-day business, apart from a couple of weeks. There's no impact. Now that's really interesting, I think. The main impact on us, taking a slight step back from the operational side of things for the companies we own, the main impact on the market for UK investors has been the huge impact on the currency, and that had a very big impact on indices. The biggest 30-odd companies in the FTSE 100 mainly are big dollar beneficiaries, and they all had an instant re-rating. They were sort of 20% type re-rating over 2 or 3 days. So that had a big impact on the index. If you were in that, it was great. If you weren't, it wasn't on a relative basis. That seems to be calming down now. Some of the companies that had these big moves are actually tracking back to where they started gradually. So it's had a big impact on indices, but operationally for the businesses we own, and that's ultimately what we focus on. That's the only bit we can really get right. That's the bit we should be focusing on. There's been minimal impact.
Okay, you said earlier that it was really interesting that there'd been no impact at the consumer level, but isn't that just because this has only just begun? That we're in a kind of holding pattern stage, so why would anyone change their behaviour in the short term?
Well, except if you look at, I mean, one of the things people like to look at with recession is the number of times it comes up on Google.
Yes.
I mean, it's everywhere, and it's been everywhere now for a long time.
But isn't that mainly just the Treasury saying it over and over and over again?
Well, and the press. I think everyone's looking for this recession desperately. And as yet, people are, infuriatingly not providing one. But it's so we'll see. But I don't believe that's necessarily a referendum issue. I think the direction of travel for the economy was not great anyway.
No.
Growth was clearly going to slow. Now, maybe it'll be a little bit worse. Who knows? I'm surprised at the amount of talk. I haven't seen before this amount of the level of discussion of recession without a more meaningful underlying impact.
Okay.
So that's slightly surprising.
You sound gorgeously optimistic. We like that.
Well, what makes me optimistic is, in a way, is just how gloomy everybody is. Everyone talks about this bull market being the least loved bull market in history and all that, which it is. But it's fascinating that everywhere one goes, people are in cash. There's lots of cash. Institutional levels of cash are the highest they've been for ages. The participation of retail investors in the market is very, very low. Most commentators are worried. There's lots of stuff to be worried about. And I think with all these sort of news events, that these moments that feel binary, like Trump, Clinton, like the referendum, people are worn out by all this stuff. So there's a lot of gloom. There's lots of cash on the sidelines, and yet markets are gently going up. And
the companies that you're invested in are continuing to grow and do well. Yeah.
I mean, the other thing that's quite bullish, I think, is the least bullish part of the equation is valuation. Clearly, yes. Valuation generally is, I think, one would describe it. I think you could argue it's normal-ish or at the upper end of the normal range. I don't think the valuations are absurd, but they're definitely
well in the UK
fairly full. And in most developed markets, I think they're reasonably full. But what is interesting is the sort of earnings recession, both in the US and the UK over the last 2 years, does seem to be ending. That may be a blip, but if you look at a sort of chart of it, there's been a sort of bottoming out of earnings. If they fell for a couple of years and they've been picking up, which is encouraging. But I guess to me the most important thing, the most encouraging thing is just how little interest there is in equity markets at the moment. It has to be good. I mean, it's better than when people are fascinated by
Yes, absolutely, because there's a lot of new money to come in when people start becoming interested again.
Yeah.
Okay. Well, on that happy note, I think we should leave it there. Thank you very, very, very much. That's really interesting. And MoneyWeek readers, you should note that we are surrounded in this office and in the corridor out here by awards. Mark seems to have won every single award on offer from every single organisation there is. So, Mark, thank you very much for your time.
Great pleasure.